Hey everyone, welcome back to Corporate Decoder, the place where we take a deep dive into company filings and uncover the real story behind the numbers. And trust me, today we've got a real interesting one. Today we're dissecting a recent report from Pelthos Therapeutics Incorporated. They've just secured a hefty loan, and we're going to break down what that means for the company and its investors. Imagine needing a lot of cash to get your medicines to people, and getting a big loan is one way to do it. This report is essentially a heads up to the public and investors about significant company events. And the big news here is a new loan agreement. Think of this as a current report that companies file when something important happens that shareholders need to know about right away. This part is a bit of administrative checking, like making sure they're filing in the right place and not accidentally covering other types of communications. It is not the juicy stuff, so we will move past it quickly. Pelthos Therapeutics has its common stock, which is traded under the ticker symbol PH on the NYSE American Stock Exchange. This tells us the company is publicly traded, and its shares are available for anyone to buy or sell. Pelthos is indeed an emerging growth company, which means they get to follow some slightly relaxed rules for a while, often related to financial reporting. This can be a double-edged sword. It can help them focus on growing without too much red tape, but it also means less transparency for investors compared to more established companies. Now we get to the heart of the report, a major deal. On the 12th of January 2026, Pelthos Therapeutics, along with its subsidiaries LNHC Incorporated and Channel Pharmaceutical Corporation, entered into a venture loan and security agreement. They're calling this the loan agreement. The other party is Horizon Technology Finance Corporation, acting as both the lender and the one managing the collateral, which is basically what the company offers as security for the loan. This is a big one. Pelthos can borrow up to $50 million. This is a significant amount, showing they likely have big plans or serious funding needs for their operations. So what is this money for? It is not just for sitting in a bank account. They plan to use it to get their already available medicine, Zelsuvmi, to more people and to launch 2 new medicines they've recently acquired, Xepi and Ziglyze. Plus, some of it will go towards day-to-day operations and general business needs. This shows a clear strategy focused on expanding their product line and market reach. Right off the bat, they've drawn down $30 million. That is a substantial initial amount, indicating they need this capital sooner, rather than later for these initiatives. There is still another $20 million available, but they'll need to hit certain company goals or milestones to get access to it. This is common in loans. The lender wants to see progress before handing over more cash. Let's talk about the cost of this money. The interest rate is tied to the prime rate plus an additional 3.75%. But there is a floor, meaning even if the prime rate drops really low, they will still pay at least 6.75% interest. This protects the lender from extremely low rates and adds a bit of cost certainty for the borrower. For the first few years, from March 2026 to February 2029, they only have to pay the interest each month, not any of the actual loan amount. This is called an interest-only period. It gives them breathing room to focus their cash flow on growing the business and launching those new products without the pressure of principal payments. Here is a smart bit. If they can hit a sales target of $75 million in revenue over a year, they get an extended interest-only period, pushing that back by another year, to February 2030. This is a great incentive linked directly to business performance. It shows the lender believes in their ability to grow sales. The final deadline to pay back the entire loan is the 31st of January 2031. That gives them a good chunk of time to get their products established and generate enough revenue to repay this significant debt. Just for getting this loan agreement in place, they paid a fee of $300,000. This is a common fee for lenders to cover their work in arranging the loan. On top of everything else, when they finally pay off the loan, there is a final payment, often called a success fee or prepayment fee. It is 5% of the total loan amount. If they borrow the full $50 million, that is an extra $2.5 million. This is quite a significant chunk, so they'll be weighing that against the benefits of the loan. They can choose to pay back the loan early, but there are penalties. The earlier they pay it back, the higher the penalty. It is a way for the lender to make sure they get a certain return on their investment, even if the borrower does well and wants to finish paying quickly. Now, for the security, almost everything the company owns, including their patents and other intellectual property, is serving as collateral for this loan. This is standard for secured loans, but it highlights how serious this debt is. If they can't repay, the lender could seize these assets. As part of the deal, Pelthos also gave the lender warrants. These are like options that allow the lender to buy up to about 65,500 shares of Pelthos common stock at a price of $27.49 per share. This means if the stock price goes above $27.49, the lender can buy the shares at that lower price, make a profit, and become a shareholder. This is common in venture lending, as it gives the lender a stake in the company's potential upside. The loan comes with strings attached called covenants. These are rules the company must follow. They can't just sell off major assets, sign certain deals without permission, or take on too much more debt without the lender's say. So they also have restrictions on things like paying dividends to shareholders or making big new investments. These are designed to protect the lender's investment by keeping the company stable and focused on repaying the loan. And what happens if they break these rules? The agreement lists typical events that would trigger a default. This includes not making payments, lying about important things, breaking the covenants after a grace period, defaulting on other loans, or going bankrupt. If any of these happen, the lender can demand immediate repayment of the entire loan, cancel any undrawn amounts, and significantly increase the interest rate. This is just a summary, and the actual loan documents are filed separately as exhibits. They are the legally binding agreements. This section confirms that the company has entered into a direct financial obligation, which is this new loan. It's essentially a public announcement of this major debt. This part talks about the warrants we mentioned earlier. They were issued without being formally registered with the SEC because they fall under an exemption for private offerings, meaning they weren't sold to the general public in a broad offering. Regulation FD or fair disclosure is all about making sure companies don't release important information to only a select few. So they issued a press release to announce this loan agreement on the 13th of January 2026, ensuring everyone gets the same information at the same time. The press release itself is filed as an exhibit, which is basically a supporting document for the report. And here is the list of all the supporting documents, including the loan agreement and the warrant forms. Finally, the report needs to be signed off by company officials. Here, Francis Newitall II, the Chief Financial Officer, has signed it, confirming the accuracy of the information on behalf of Pelthos Therapeutics Incorporated. So, what is the big picture here? Pelthos Therapeutics is taking a significant financial step to fuel its growth, specifically by bringing new and existing pharmaceutical products to market. The $50 million loan, with $30 million drawn immediately, shows a strong commitment to these expansion plans. The extended interest-only period tied to revenue milestones is a smart incentive, directly linking debt repayment to business success. However, it's crucial to remember that this loan is secured by nearly all of the company's assets, including its intellectual property. That is a critical risk factor to keep in mind. The warrants issued to the lender also mean potential dilution for existing shareholders if the stock price rises significantly. Overall, this move signals ambition and a strategic push to scale up operations. The success of this strategy hinges on their ability to effectively launch and sell their products, achieve those revenue targets, and manage the substantial debt. It is a calculated risk typical for companies in the exciting but capital-intensive pharmaceutical industry. That is our breakdown of Pelthos Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Are they well positioned for growth, or is the debt too much of a risk? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. And don't forget to check out our Discord community linked in the description for more discussions and direct access to our team. Thanks for watching. See you next time.